That's no surprise to our next guest. He wants to see more by the Fed and says the markets love liquidity. Joining us now is Wharton finance professor Jeremy Siegel. Professor Siegel, good to have you back with us. I mean, are you banking on a QE3 here to help juice the markets?
Not necessarily QE3. Remember, there's a number of things the Fed can do to stimulate and to provide liquidity without that. One thing that even Bernanke mentioned in his news conference last time was reducing the interest rate on reserves to get the banks to lend it out. The Fed could actually put a subsidy on lending to small businesses, which are the ones that have reported some difficulty at getting credit. There's a lot of actions short of QE3 the Fed could take. And I think it was very interesting today when that little window opened up that the Fed might be doing something. We saw the Dow spurt up about 50 points. So they're hungry for some Fed action over here.
But Jeremy Siegel, let me ask you, earlier in the year when Carol and I were talking to you a lot more often, you were concerned that the Fed may be behind the curve when it came time to raise rates. Have you reassessed that opinion now? Do you think they need to wait until later considering the soft patch in the economy?
Yeah, I have. I really thought the economy was going to be, much stronger than it turned out to be now. And we've seen oil come down. We've seen gasoline go from $4 down to around $3.60. There's some ease. Food has gone down a bit. So I see some easing of those pressures, which makes me feel there can be some more measures taken. Not necessarily, again, adding to the reserve base, but encouraging the banks to lend out more than $1 trillion of reserves that are excess reserves they're carrying on their balance sheet.
Jeremy, you still are upbeat about the market outlook. I think you're looking for about 10 to 12% gains in the second half of this year. Is that contingent on the Fed pulling something out of its toolbox here, doing something?
Well, I think it's more contingent on the slowness of the first two quarters being the temporary slowness, soft patch, which Bernanke has enunciated. We're expecting acceleration of growth to the 3 to 4% GDP region in the third and fourth quarter. Now, I know the last jobs report puts a question mark there, and that's why the market had sold off so much. But if we get this rebound from those temporary high gas prices, the earthquake tsunami in Japan, and several other features, I easily can see 10 to 15%. The market is just so cheap. Look at earnings. One thing I say, the growth in the first two quarters in GDP was fully 2 points below the estimate that forecasters had in January. Yet in both these quarters, it's forecast that S&P earnings are going to beat estimates. Think about it. If they can beat estimates in a slow economy, what will they have as earnings if the economy speeds up? And I think this is the positive feature that investors can look forward to.
What about the question of jobs, though, Jeremy? I mean, you can see companies beat estimates by firing people. I talked to a lot of skilled workers, U.S. skilled workers who are being replaced by foreign workers. Do you think it's possible to have a recovery of this recovery, but no jobs added back to the economy?
Well, to some extent, that's what we've had. We've had earnings more than bounce back all their loss. We've only added 1 million net jobs. I think we had 7 million lost. So there has been a lot of economies there. One of the things that, and I heard, Warren Buffett speak and other forecasters, until we get that housing market pick up, and we cannot stay at 500,000 housing starts a month. That is 1/3 of the long-run average of what we need. That is going to provide an awful lot of jobs, and I think that is the major reason why job growth has been so sluggish so far in this recovery. Again, I don't know when it's going to turn. All I know that everyone I talked to said there's no way we can stay at 500,000 given population growth, given household creation, and that's going to be a meaningful source of employment growth when it catches on.
When? That's the big question. I mean, Jeremy, when does the disconnect between healthy corporate America, who have tons and tons of cash, between those millions and millions who are unemployed, who have houses underwater, when does that catch up and start to be really reflected once again in the market?
Well, Carol, part of that is a reflection of the fact that 40% of S&P profits come from abroad. emerging markets are still growing 7% a year. We're selling to those emerging markets, and I think that is what's keeping the profits up. Also, we know the corporate tax rate in the U.S. is among the highest in the world. They have lower tax rates in Europe. They have lower tax rates around the world outside the United States. They have higher margins on their sales outside the United States. This is the reason why corporate profits have stayed healthy. It's a fact of our global economy that S&P profits and U.S. GDP are not one for one the way they used to be in the post-war period.
Certainly a different way of looking at the markets. It really has changed.
Yeah.
Professor Siegel, we're going to have to leave it there. Thank you so much. We appreciate it.